Welcome to this session on previous year's questions. So we'll be solving the previous year questions in this session regarding two terms. So let's start. So this is the first question, and in this we see it says that which one of the following is the value of inventory on January 31st under perpetual inventory system of last in first out. So whatever goes last in first out. So now this is, as on 31st January, we have to calculate, and what we see here is the dates are there: January 1, 8th, 6th, 9th, and 25th. So let's put it in the order first. So 1 would be this, 2nd would be this, 3rd would be this, and 4th and 5th. So in this order, we are proceeding. So last in, first out. Okay. So on 1st of January, the inventory was 200, right, at 7 rupees a piece. So total value was around 1400 rupees. Then on 6th of January, that is number 2, there is a sale of 100. So those 200 pieces are there, 100 gets sold. So whatever is left is now is only 100. So 100 has been sold, 200 were there, 100 has been sold. What is left is 100, and that is priced at 700 plus 7 rupees, right? Then third purchase of 1100 units at the rate of 8 rupees per unit. That comes out to be 8800. But this is 8800 plus the 700 that we carried from the previous month, right? Now, fourth transaction happens on January 9th, where the issue of sale is of 200. Now, last in is this. These were the first and this was the second. So now from this we take out how many pieces? 200. So 700 still remain, plus 200 I have taken out 4 rupees, 8 per. So 1600 goes out. So 8800 minus 1600, and we're left with 7200. Right? And fifth transaction, again a purchase happens. This time the purchase is of 309 for price. So we had 700 plus 7200 plus another 2700 gets added tot. So this is the final value as on 25th of January, and there is no other transaction shown. So as on 31st January, it will be 700, the first one, 7200 from the remaining of the 1100, and then the third price comes down to be 2700. So the total makes out to be 3400 and 10600. So that is option C. So now when we see the solution, it says on January 1st, it was 200 at the rate of 7. And then the remaining 100 are left as each of 100 has happened. Then we buy 1100 at the rate of 8. And this is the balance that we can see. Then last in, first out, we are left with, some 200 are taken out from this and 900 remain here. And by 300, and this is how it adds out to be this one, right? So this was the solution for the question. Now let us look at another question. So it says that the additional bad debts during the year are 2 lakh rupees. So following the trial balance of a firm on 31st of December 2022. Okay, trial balance, we just understood what it is. So it can be taken at any stage. So the additional bad debts during the year are 2 lakhs. The firm has a policy of maintaining a provision of doubtful debts equal to 10% of the trade receivable balance. Right. The total amount has to be charged to profit and loss account for bad debts written off and provisions claimed. So we have to basically tell them that what is the total amount to be charged for profit and loss account, what is to be shifted to profit and loss account for bad debts written off and provisions payable. So basically we have a trade receivable of 25 lakh rupees, right? Out of this 25 lakh rupees, this is the money which are to be received. But we think that this money may not come. 2 lakh rupees may not come. So that is an additional bad debt. So what is left is actually 23 lakh rupees. Right? Now already bad debts are there. That is 40,000 rupees. Okay. Then they say they keep a provision of 10% of trade receivables. Now remaining trade receivable is 23 lakh. They keep a 10% provision for this. So they basically keep a provisioning of 2,30,000 for this, right? This is the basic provisioning they have to keep. So they are keeping a provision of 2,30,000 plus already incurred bad debt. That is 40,000, right? Now what has happened is they have already provisioned doubtful debts for 1,40,000. So we subtracted 1,40,000 from this. So 2,30,000 is the provisioning for this, plus 2,40,000 is the amount which is to be provisioned. So total amount that is to be provisioned is 4,70,000. See how we got this, and then we have to subtract 1,40,000. So how we got this number? This 2,40,000 includes both the already bad debt and the additional bad debt. So this amount comes from there. 2,30,000 is the provision for the remaining amount. And then we subtract the already provisioned amount. So we are left with 3,30,000, which is the option D. Let's check the solution here. So debtors have 25 lakhs to pay. Extra bad debt in the year 2 lakhs. Already provisioned 1,40,000. Adjusted debt was 2 lakh, now 23 lakhs. As per provision of the policy, we provision 2,30,000. Opening provisions or opening bad debt, I would rather say, was 40,000. So bad debts, that is 40,000. Plus increase of provision. But bad debts also includes this 2 lakh rupees. Plus increased provision of 2,30,000. Minus the already provision amount is 2,40,000 minus 10, we get this answer. So this is how we solve this question. So this is a simple question on trial balance. Now let us understand another. Accounting to Accounting Standard 1. Which of the following are fundamental accounting elapses? We know that this is GAC. We learned that. There is going concern, yes. Accrual and consistency. So this A option is the right answer. Going concern, consistency and accrual, GAC be remembered as a accounting standard 1. Now let us move to another question. It says the insurance claim received on account of machinery damage completely by fire. Now see, this is an insurance claim. This money has been received. So what has been received is a receipt. And what kind of a receipt is this? Because money is being received for it. So it's a receipt. So these two options automatically go out. So whether it's a capital receipt or a revenue receipt. See, capital receipt is which is not regular and is in lieu of some asset. Revenue is a regular affair receipt. So this is irregular and this is regular. From now you remember regular and revenue. So this is one-off case. So it's a capital receipt. So insurance claim received from a loss of a fixed asset is a capital receipt because machinery which was lost was also capital. It was a capital investment which was lost. So that time it would have been a capital expenditure. Now it is a capital receipt. It is not a normal form of business operation, but an extraordinary event that affects capital structure. Right?